Yes, hello. Good evening. Welcome, everyone. Again, this is our Nurse Founder Forum live chat, where every Tuesday, 7 p.m., we bring you valuable insights on business, finances, mindset, and leadership so you can build additional income, create impact, and design the life that you truly want. Today, our topic, we're going to talk about mortgage strategies, and I'd like to introduce my friend and also a global mortgage advisor to give us some tidbits. He has more than 10 years experience on this industry as a global mortgage advisor. Let's give it up for Oscar Acosta.
Hi guys, my name is Oscar, and thank you, Chris, for having me.
Thank you so much. So we're talking about, for a lot of my clients are doctors, healthcare. Sometimes they're paying a lot of taxes, and but some of them are starting to, buy a home. How is the? Can we talk about more on the precision mortgage strategies?
Okay,
Mhm.
so let me share my screen, okay, and then
Yeah,
that way you guys can see what I'm talking about.
definitely. Yeah, because right now so many people are, when you're making $150,000 and up, your taxes is 24% and higher. So that's why diversification is the key.
Okay, can
Yeah,
is there like a comment box or something? How many people are logged?
yeah, we can see you right now.
Okay,
Mhm.
I'm on the chat, and all right. Apparently, I can't chat. But one of the things that when it comes down to for example, real estate financing, I'm a broker. So what that
Mhm.
means is that my bank is a bank that works with a lot of different kinds of investors. And so I work with real estate investors, first time home buyers, people that want to upgrade, downscale, want to buy a shopping mall. And so there's products for all sorts. And one of the niche, very sort of, it's not very common, is what's called physician's loan. And a
Mhm.
physician's loan is something a little bit special. So if anybody wants to follow along, or if they want to copy the presentation, they can take a picture of the QR code, and the QR code will give you a little sign-in sheet with for your email, and then you'll automatically get that presentation. Okay.
Mhm.
Also, my contact info if you guys have any questions or anything about they want to talk about real estate financing, and I'll be glad to help you because everybody's situation is unique.
Yes.
And so there you go. Sorry. Okay. Now, physicians are in a unique sort of situation where, like, student loans in medical school, it's really, really expensive.
Oh
And,
yeah.
like, a lot of times, like, when somebody's in their residency, like, you know, they have a lot of debt, but not necessarily a lot of income.
Mhm.
And so, if you've gone through the whole process of going through medical school and like it's undergraduate, like maybe a graduate degree, medical school, residency, it's a long, long time before you start earning the kind of money that you want that accompanies like all that hard work. And physician loans are uniquely positioned to sort of help you with that.
Mhm.
Because, like, during your residency, like, you might have like 300, $400,000 worth of debt, but you're only really making it between 70 and $80,000 a
Yeah,
year.
at the
So, like,
beginning,
yeah.
yes.
And so when a lender looks at a loan, they're going to look at three basic numbers. They're going to look at credit, DTIs, and assets. So the credit helps determine to see if you qualify. And if you
Mhm.
do qualify, helps determine the interest rate. Then DTIs, it's what becomes a problem for physicians and physicians in training, in the sense that the way that it works is we add up all the debt and then divide it by the income.
Yeah,
That's
for
Monday?
yeah, just for those people that would like to know what DTI is, this is debt to income ratio.
Yeah.
Just
So you add up all the debt. Debt's defined by whatever appears on the credit report, like credit cards, student loans, which for a physician or a resident, it's a lot. Credit cards, student loans, alimony, child support, back taxes. Okay. any installment loans that you have, like car payments, stuff like that. And your income is defined by what you do. Now, typically for a typical loan, typical mortgage application, we go by what's on the pay stub. However, when you're a resident and you're making $70,000 a year, $80,000 a year, that pay stub does not reflect your earning potential. And so that's where physician loans are a little bit unique because it's based not on what you do right now, but on what you're going to earn in the future, up to
Oh,
150 days in advance.
it's like
Because typically,
accrual.
yeah, because typically, like whenever you buy a house, like we go with whatever the 30 days most recent pay stubs. But physician loan will take that offer letter that you've gotten for like your next job up to like 5 6 months ahead. Okay.
Mm-hmm.
And so one of the other things is that like if you've been paying for medical school and like or you're barely getting started, like you have a ton of debt and you might not be earning that much and you definitely don't have a lot of savings. And so physician loans are uniquely sort of positioned to kind of help you with that.
Yeah, does it require that they have for this to be eligible? They need to have a offer letter. How many months do they need to be with their employer so they could start?
150 days. Up
Oh, 150 days.
150 days. On a typical loan, like you can start with an offer letter, but you need a pay stub before you close. With a
Mm.
physician loan, as long as you have an offer letter 150 days up front, then that will, you know, help you get that.
Wouldn't
Now,
they ask for the past 6 months on the pay stub, or is that required for
you
this?
know,
No.
it's just the
Oh,
offer letter.
oh
So
wow.
yeah, so you might be earning right now 60, 70,000, but then, or like you're about to, like it works like if you're just got out of medical school too, and you barely getting your first job. Or if you're a resident and you are about to finish your residency and you have a high, like a very high income, like job lined up, you can get that house before you even start that job. Okay.
Mm-hmm.
So one part of the reason is that like these loans are kind of very niche, but at the same time, like they're pretty much based on the fact that like, physicians tend to have one of the lowest default risks, like it's steady income no matter what, like it's recession proof.
Yeah,
Banks
economic
understand
proof.
that.
Yeah, that's why a lot of my clients are paying a steady income, steady taxes.
Mm-hmm.
Yes, W-2. So this
Yes,
is a good investment strategy.
I've
But,
seen those tax returns. Yeah.
oh yeah, there's a lot. One thing in Atlanta, Georgia, he made 1 million. I think it was 250,000 on taxes. I was like, dang, it's a lot.
Mm-hmm.
With this, is this all? Does the home buyer credit applies for the first time, or how does it work with that?
The way that it works is it has four basic features which are on screen over here, and like I don't know if it's a little bit cut off. Let me
Mm,
see, because I think
yeah.
on the
Okay,
screen.
there you go. Yeah.
Let me see if I
You
can
can try to maximize.
share.
Okay, there you go. I make the most
There you
out
go.
of it, but
That's a
we're
little bit better. I'm just
yeah.
gonna do
Okay, there
this
you go.
for the moment. Oh, there
Mm-hmm.
we go. Better. Okay. So one of the main features is that every loan, unless there's 20% down, and most residents or people barely getting started with the careers don't have that 20% down, will have what's called PMI, private mortgage insurance. And this is a special kind of insurance that doesn't protect you, but it protects the lender's investment. And so it usually is, it's part of your monthly payment. Physician loans are the one loan outside of the VA loan that does not have any PMI. So that's actually
Mm-hmm.
what makes the VA loan so exceptional, is that it's like the physician loan, like the VA loan has no down payment
Yeah.
and no PMI. So you're
Oh,
really just paying the principal and interest, which is the money that you're borrowing, plus the tax and insurance on the house.
yeah. I have a question.
What's up?
What is the PMI for the private mortgage insurance?
The private mortgage insurance is a special kind of insurance that protects the lender's investment. And so
Uh,
when it's a financial device that was developed like I think it was like in the 90s, in order to make home purchases like easier for people that didn't have 20% down. Because back in the day, if you didn't have 20% down for a home, then the banks would consider that a very big investment risk.
mm-hmm.
And so with no down payment, they wouldn't issue out loans. So what they came up with is this special kind of insurance that if the person defaults, that insurance is going to pay the lender, and that
Yeah,
way the lender's protected on their investments and paying
especially
them.
for bankruptcy, right?
Yeah,
So the PMI covers it.
yeah.
But this one, it's not required for the
It's not
physicians. Just,
required for physician loans because of the low credit risk that they represent.
mm,
And once again, like the powerful thing about this is that like you don't have to actually have that high income job now, but it works like if you're
like
gonna get it in the
projected.
next 150 days.
Yeah.
And the other thing that has a really unique feature of this loan is basically it doesn't take student loan accounts into debt, and
Oh,
that's a
wow.
very very big thing because usually on a typical mortgage application, if you have student loans, even though they're in forbearance,
Mm-hmm.
unless there's a zero on your credit report that says like the payment is zero, which usually they don't, we need to take account into a small amount of the percentage of that loan as a potential payment, even if they're in
Mm-hmm.
forbearance. With the physician loans, it doesn't. So the basic idea is just to keep things simple. Is let's say somebody makes $10,000 a month, and it's just to give you a round number, then all the debt, including the mortgage payment, should be more than $5,000. That's what we call 50% DTI. So somebody that makes $10,000 a month, and like I said, just a number, and have no debt, technically they would qualify for a mortgage that which payment can go up to $5,000 a month.
Mm-hmm.
Now, somebody with a lot of student debt, even though they're not paying them right now, but we'll have to pay them at one point or another. We have to take that payment into account. Might have like $1,000, $2,000 worth of student debt. So instead of affording a home which payment is $5,000, they can only buy a home which payment the max is $3,000 or $2,000. We don't know. It depends on the student loan debt. And so the physician loan doesn't take that into account. So what that really means is that you don't have to pay it. The physician loan pretends there is no student loan debt, and so you qualify for more until your end. Like basically, that allows you to buy the house of your dreams now until your salary sort of catches up,
Yeah.
and then you start making that big money, and you don't have to wait to make that big money. You can buy it, up to 150 days in advance, and then, like I said,
120. Okay. Is it 121 days or
150 days.
150 days? So in other words, just a recap. This is not the traditional because no PMI needed, which is the private mortgage insurance, and also you do 100% financing, and
Mhm.
the student loans excluded. That's a very good leverage.
Yes. And the last thing is, of course, that like you don't need that pay stub right now to say that you're earning $15,000 a month. All you need is an offer letter saying that you're going to earn a certain amount 6 months in advance, and that's like I said, that's very different because on a typical mortgage application, then you need that pay stub for us to close on that loan.
Oh, all right. So we've been working with so many lenders before. Do credit score matters?
Credit score does matter.
Mm-hmm.
So we have a oh, here's my little explanation of what the PMI is. We have a one of the next slides will address like the credit score.
Yes.
But before we jump into the credit score, the
Mm-hmm.
credit score is very, very important, and it does determine the max loan to value, like how much you can borrow.
Mm-hmm.
So they do need a decent credit score. However, one of the other things that the credit score affects is the credit score usually affects how much you have to put in down payment, what the
Yes.
interest rate is on the loan, but it also affects what a lot of people don't know is the rate of the PMI. So because there is no PMI on this loan, your score doesn't affect the PMI and therefore it doesn't add to that. So for example, in not paying the PMI, that's actually quite substantial. On a $700,000 house, the PMI can vary between $400 $600. $1 million house from 600 to 900. Half 1.5 is 9,000 to 1,400. So that's a hefty amount of money
Yeah. Yeah.
that
That's
doesn't reduce your principal. that you're saving.
Exactly, because even the minimum of 400 times 12, that's already close to somewhere 5,000. That's a big savings that they can use that 5,000 somewhere else
Mhm.
without the PMI. Wow. I didn't know that. But does it matter? Is there like a minimum amount of the purchase price of the house for the for this precision mortgage to qualify? Should it be more than 700,000 the worth of the
No,
house? Oh no.
there's no minimum. The maximum is 2 million.
Oh wow. So there's no minimum, guys. There's a maximum amount of $2 million.
And like right now, I'm helping this resident who is not
Mhm.
earning a lot of money. He barely got out of medical school, and he's gonna earn like as a resident, I don't know, for like 3 years, like 70 grand. I'm helping him buy his first little home for $400,000, but with no down payment. Because
Mhm.
he really, I saw his bank statements. He has nothing. He worked like 3 jobs, through medical school and his residency. He has nothing, but he's gonna be able to, with his future income, he's gonna be able to get his first house.
Mm.
So this is more or less like, for example, how it looks. The max is 2 million, 0% down payment, no
Mhm.
PMI. The max ATI is 50%, which is traditional for all loans. Student
Mhm.
loans are excluded. 150 days prior. Full time, first time home buyers eligible. Even second time, third time home buyers are eligible as long
Mhm.
as they live in the house. And the underwriting means it's full review. So typically, most loans you just kind of fill out the form and then put it through the algorithm, and the algorithm will weigh all the factors. What manual underwriting means is that a real person's going to look at it. Like a real person's going to judge like whether we have a loan or not, and they're going to look at the specific situation because no two situations are similar. Something that when I first started doing loans like a long time ago, I remember the person that taught me, Miss Emma, like
Mhm.
Oscar, like you're all cocky and whatever, but like you don't know anything. Like you have like you pass the test, whatever, but you don't know anything. Like every loan is always different, and I've
Mhm.
learned that ever since. Like every loan, every situation is different, which makes it into advantages. This is a manual underwriter because a real person's going to look at the loan, and you can talk to this person and you can explain, well, it's because like medical school or this or that or whatever, and you can negotiate, which is a very important thing.
Mhm.
And so when we talk about physician loans, it's super important that like not what a physician actually means. And so this
Mhm.
is a clear definition of physician. It applies to medical doctors and doctors of osteopathy, doctors of pharmacy, doctors of podiatric medicine,
Yes.
doctors of
Mhm.
dental science or surgery, doctors of veterinary medicine, and certified registered nurse and anesthetists and residents, fellows and
Mm.
residents.
Okay, that's
So
good. This qualifies all my clients then. But is it within the U.S.? I mean, within the U.S., right? You go
yes,
more than Texas, correct?
it's within the U.S., not just Texas.
Oh, okay. So, and how long, for example, like walk me through from start to finish, the turnaround time. For example, they gave you the offer letter 6 months.
Okay.
How fast?
Turnaround times for a loan is typically around 30 days. So the way that would process would work is you and I have conversation, the client and I have conversation, and we figure out like your situation. Now, usually I always tell my clients, like, consider me your financial priest. Like, I need to know everything in upfront so I can fix it, you know? And then we see what your unique situation is.
Mm.
From there, we do at least a soft pull on the credit, and then we fill out like the form and like where you work, your school history, like when you start your job, like if any, like do you have any savings or whatever. We go over your unique financial situation, and then I issue out a pre-approval. Because of this, the minimum requirements of this is really we can just start with a decent credit score. I
Mm.
believe 680 is the minimum for a physician loan.
680.
Yeah,
Okay, that's not
start off
bad.
with a credit score and that offer letter, and that's
Hmm.
pretty much.
It's like getting a car.
Yeah.
Not
Now,
bad.
every loan has closing costs, and closing costs are the cost of the transaction. So when you buy a house, you have to pay for the tax and insurance of the house.
Mm-hmm.
That's sort of typical. Then the other thing that probably is like another closing cost is, for example, whatever the title company is going to charge. The title company is an independent third party, and they grab all that documentation and verify that everything's legal, that everything's on the up and up, that the seller pays whatever they're supposed to pay in taxes. That's like They collect all the monies from all the different parties. They
Yeah.
calculate the invoices. Now they
Mm-hmm.
have a fee. So a typical closing cost of a loan are around 3 to 4%. Now,
Yeah.
something important for somebody buying a house, particularly for the first time, is that the physician loan will cover the down payment,
Mm-hmm.
but it will not cover the closing costs. So you do need a little bit of money.
Yes.
The other super important thing to consider is that closing costs are negotiable between the seller and the buyer.
Yeah.
So let's say you find a house that you like, and it's listed for 400. You go to the seller and you can tell him, hey, we'll offer 400, but I want you to help me pay for closing costs. Now, realistically, if the house has been in the market for a few months, you have a pretty decent shot that the seller's going to be willing to pay for half, if not all, of the closing costs. However, if the house has, like, 10 other offers on the table, seller's pretty much going to go with whichever offer that they get the most amount of money.
Mm-hmm.
Okay, so now in this market right now, I just got a contract where, like, the seller is the house is going for 400, and the seller's offering like 6% of closing costs. So that
Yeah.
pretty much is going to cover like everything. So
Mm-hmm.
it's important that we have this conversation. That way you have the most amount of options and you understand the timelines, how everything works. Now, once
Mm-hmm.
we have those numbers figured out, like, the potential cost of everything, you go shopping
Mm-hmm.
and you put in an offer. Now, your offer might be accepted right away, or it might take you a little bit for you to find your ideal home. That's fine. Now, once your offer is accepted, we have typically around 30 days to close. From that point on, you offer the offer is accepted. I get the contract. We disclose the loan. You get like what's called the first initial loan estimate. We have
Mm-hmm.
the numbers, and you're gonna see like a padded loan estimate where, like, there's a rule in loans that there cannot be any surprise fees, and so all the fees are there. Okay,
Yeah.
and usually the way that I tell my clients is, like, I personally hate it when somebody tells me, like, hey, it's going to cost $100, something's going to cost $100, and then something happens, like, oh wait, I'm so sorry, it actually costs 120. I
Yeah.
hate it, so I try to. That's why I pad my numbers. So,
But what are those surprise fees that you've encountered before?
for example, sometimes, like, a house can require a second appraisal.
Oh, oh yeah, yeah. From the
Yeah.
isn't it So do you work? This does not need to have broker. Like for example, my friend wants to sell his house. That would be okay, right? Between us and then you. You
if
don't need a
they,
broker.
if they want to sell the house,
Mm-hmm.
I do mostly the financing side of it. So if somebody wants to sell the house, the only time I come in is if they want to sell a house and buy another house. Then I help them set up the financing for the next purchase, which is actually
Yeah.
really important,
Mm-hmm.
because a lot of times that people buy homes or bought homes like 5 years ago, and the market was very different, and their job might be entirely different, their credit might be entirely different. So it's very important that before they sell the house, they actually get pre-qualified to purchase the next one, because their situation might have changed, because rates are higher than they were like 5 years ago.
Oh yeah. Do you do softball at the beginning? If I initial apply.
Yes, it's doable, but I honestly, most of the time, I don't recommend it, because
Mm-hmm.
a softball is not the most accurate thing in the world.
Ah, okay.
And
So
so, if the credit, for example, if the loan requirement is, or the loan minimum is 680, and we do a
mhm,
softball and your softball says 680, we don't know your real score, because softballs I've seen softballs vary up to 40 points.
which is
So
not
if your
accurate.
yeah, it's not. It's a guesstimate. And
Mm.
so the softball says 680, like your real score might be 720, which is good, or it might be 640.
Yeah, because some credit card, yeah, you have your own. I mean, we have what's this credit score? Anyways, you have to rely with a third party, or you're
Yeah.
using your own, right?
Yes, we lenders use, and all lenders use the same FICO. So there's three credit bureaus: there's Experience and TransUnion and
Yeah.
Equifax.
Mm-hmm.
And the one that is used is not the highest, not the lowest, but the middle one.
Mm-hmm.
So if one scores 720, the other one's 700, and the other one's 680, 700 is the one that, like, lenders will have
They're
to
gonna
use.
get, yes. Would they? Can they come to you and then they said, well, the other bank already pulled out my credit score less than 15 days. Can you use that or no? Like
No,
you have, oh, you have to do your
no.
own.
Lenders can't interchange credit bureaus, because it's part of the compliance process
Mm-hmm.
where we need That credit, we need everything to be lined up in a specific way. And
Yeah.
also, we also, maybe for the physician loan, to be honest, I haven't tried it yet, but most banks don't. They have
Mhm.
to repull their own credit with their own vendors, and that's just kind of like a compliance thing.
Yeah. Would you require tax return on the
For
closing?
physician loan, no,
No. Okay, that's good.
no, just the
It
offer
saves a
letter.
lot of paperwork.
It
Oh,
is.
by the way, I have a question. Because there are loans that are HELOC. Does this also qualify for HELOC?
A HELOC is a different kind of loan, and you don't need to be a physician loan for that.
Mm.
But for example, you can use a physician loan to refinance a house and get some cash out.
Mm-hmm.
But that would be a cash out, not a HELOC. A HELOC is a little bit different,
Okay.
but and you still pull equity out of the both.
Yeah. Well, that's good to know. How about one more thing? I'm not sure if you're aware. Some of my clients that are doctors, can this qualify when it's a duplex or fourplex?
Yes,
Oh, they can do that. Okay,
one
even
to
they
four
don't
units.
live there. For up to maximum is how many? Four?
4 units.
Oh, wow. So they can easily.
Yes, but they have to live in one of those units.
Oh, I
So
see. I see. Yeah,
the physician loan doesn't work for investment
for
property.
investment, it
It
needs
works
to.
for their primary, which
Yeah.
is a great idea for somebody to buy their first home, like a duplex, triplex, or quadruplex, because the FHA loan works the same way. Because
Mm,
they can buy that home and then use the rental income of the other units to offset the cost of the mortgage.
yeah. So basically, they need to live there for certain because there are some cases they switch their primary home to become the rental, like single family residence.
Mhm.
I think what you're referring, and also with the IRS, you need to live there on certain number of years, like 2 years or 3 years, right? So is there like a minimum requirement? For example, I got the loan for 2026, but I'm planning to convert this as a rental property on 2028, like year 2028.
You're fine.
We're fine, right? 2 years. Okay. Well,
It's actually okay. So you can. There's no such thing as mortgage police.
oh yeah, yeah.
So
I get that.
technically, technically, legally, you're
Yeah.
obligated to live. I think in the house like 6 months.
I see.
It depends on the kind of program, but basically the way that it works is like you have to go live in the house, and that it has to make sense. You
Mhm.
can't have like a $2 million home and then go buy and say they're gonna buy a duplex for like $600,000 because
Yeah.
it's not believable that the person that lives in $2 million home is gonna go live in that duplex. I mean,
Right.
unless they're like really senior and they're downsizing or whatever. So it usually works. That strategy usually works when somebody's buying a house for the first time
Mm-hmm.
because like it has to make sense. Like it's one of the things about like the underwriter is going to look at it and they have to like nobody goes from a really nice home to duplex. So because it's only intended for a primary, like it works. That strategy works for particularly for first time home buyers.
Mm. Yes, we are reaching on up to the last minute of our presentation, guys. If you have questions, we left Oscar Acosta's contact information so you can have a book online, one-on-one consultation. So that's good that you are not limited to Texas alone. There, but and then one more thing. So, if they use this if they would like to buy a house for example, April, and then they decided to buy another house on after mid year, would that be okay or no?
Yeah,
Oh, that would be good.
as long as it looks and feels and tastes like they're going to live in the property.
Yeah. Okay. There you go. So what are we seeing right now? Is this another conventional imposition loan?
It's
Okay. So
just a little bit of explanation of how student loans
yeah.
work.
Yeah.
Kind of sort of cover that. Oh, there we are. So this is the credit score requirements: 680 minimum for like for the down payment, and if you have a 680, you can go as high as zero down payment on 1.5. If your score is 720, you can go as high as $2 million
Mm, okay, oh wow. The
with
higher the
no down payment.
the higher the credit score, the better. And
Mhm.
the payment terms are just the same, right? 25
They're
years.
30 years fixed and they're 30 years fixed. No prepay. Uh, yeah, no prepay. So that means, yeah, you can like make extra payments, and the payments will go to reduce the principal. It has all the protections of a regular Fannie Mae Freddie Mac loan.
Mm-hmm. Can they use this loan to upgrade? Let's say like a like kind, where they're gonna buy sell their primary and then buy another
Yep.
one. That
Yeah.
okay. This is a
Absolutely.
yeah, this is a good strategy because I think for me I would rather buy a fourplex. I would than the other one because I'm there are house fourplex that are for sale that they already have tenants,
Mm-hmm.
right? So I'm just guys, this is a good strategy because you have to understand that you need to, the more income you're making, the higher tax bracket you are, and you could actually use the concept of depreciation if you're living in one apartment complex out of the four units, and then those rental income that you're getting is the one that you can pay for the mortgage. I have that doctors that they're doing this. They already have they purchase a fourplex, and they live in the other unit, and then the three already have tenants. That would be cool, right? That also
Mm-hmm.
works. Okay,
Absolutely.
perfect. All right, guys. That's all that we have today, and we would like to acknowledge and thank a good friend of mine who just celebrated his birthday last week. Belated happy birthday. All
Thank
right,
you.
so guys, that's a good. I should have known this before tax season. Before, because the 200,000 of taxes for my doctors is a lot of money rather than paying taxes. So there's a legal ways, and there are loopholes if you're putting your money on investment or on your business, and then assets. House would always be a good leverage as
And
your.
Chris and I can work together to make sure we take advantage of every single opportunity.
Yeah, no, I remember. Yeah, I do have. I made Rolodex before that. They actually, Oscar. One problem they're having is the student loan, and they cannot get a house. They just barely graduate as a doctor. So this is an alternative, and it's a good strategy for them to own a home. I will contact them and then let them know because I haven't heard this kind of strategy. I heard a strategy with the IT. Yeah, I heard those. So that's one thing, but this is a different.
I do those too. A lot
Yeah,
of those, to
yeah,
be
that's a
honest.
good thing with you is you
Yeah.
also do that. So there's no escape. But since our viewers are more in the healthcare and high end, by the way, you also accommodate
Actually,
aside.
I'd like to correct you on that. There's a lot of I-10 investors that are very, very high earners.
Oh
It's
yeah,
just the
definitely. Oh
paperwork's
my
kind
God,
of
yeah.
more.
I heard they own the biggest businesses when I was in the valley.
Hmm.
Yeah, the tire shop, the car detailing, or they were just buying home cash.
Hmm.
So
Oh
I
yeah,
was like,
they do a lot of that.
and then their expenses are their net income is negative in the tax return. You know
Yeah.
what's happening, but they have 25 properties. Yeah,
Mhm.
so it's all about that leverage and knowing the right person to talk to. And so guys, remember, you don't have to do this alone on investing. We are here to provide you tidbits of information. Please watch this replay. This is good for the next 30 days. And we are proactive on education because what we want from you guys is
Hey,
you
Chris,
are
can I share
proactive.
one last screen, please, really quick
Oh
before you
yeah,
log
definitely. You can share one more screen. Yeah. Okay.
off? Okay,
Uh.
so there we go.
Oh wait, wait, wait.
So
Okay, there
that's,
you go.
did it work?
Yeah, it works.
Okay. So that's the QR code. That'll get you a copy of the presentation
Let me know.
and my information, so we can talk. Okay.
Okay, there you go. I love QR codes. All right. Yeah, I got your QR code. I'm gonna pass it on to some of my clients. One more thing. Does it apply with chiropractors?
No.
You mentioned dentists, right?
Yeah, and I told you they don't count. Sorry.
Chiropractors, no. But
I Yeah.
I
No.
see, I see. Okay, guys.
Real
Yeah, but
doctors.
all right, there you go. At least, it's good to know who qualifies and who don't. Okay, guys, what are your takeaways? Please comment below. Let me know. And we are providing. Please stay tuned. This is a regular Tuesday for Nurse Founder Forum live chat at 7 p.m. Again, I'm your host, Christopher Waikoko, the current chairman, Bachelor's of Science in Nursing, and founder of Nurse Founder Forum and Allied Healthcare Entrepreneurs. Thank you, guys. Oscar, thank you so much. I'll catch up.
Thank you for having me.
Yeah. Have a good day.